Good day, everyone. This is the second part or continuation of PAS 1, presentation of financial statements. Make sure to check that out, the first part of this particular series. So I'm going to continue my discussion, and this is all about, again, presentation of financial statements. And this time it will be on deferred taxes. So deferred taxes basically are items of taxes that are not yet paid, hence the word deferred. So they are going to be recognized because they will result to certain future taxable items, meaning certain items like income items are to be taxable in a future sense or time, or certain items will become deductible, like expenses, future expenses. So that's why they have to be deferred for the time being, as opposed to current taxes in which they have to be paid in the current times. As a rule, it is clear here in IAS or PAS 1 that deferred tax assets or liabilities, or the reverse, are always presented as non-current. Always at non-current in the classified statement of financial position, irrespective of their expected dates of reversal. So meaning even if they're current or they're going to reverse in 12 months or less, or normal operating cycle, whichever is longer, but then still they are to be presented as non-current. So that is a clear ruling there. Next one will be the minimum line items in a statement of financial position. So these should be the items that we can see on the statement of financial position, also known as balance sheet. In fact, we can see the order. These are from here to F. These are actually non-current assets, while G to J, these are current assets. So this is the format that we normally see under the European or UK version, wherein they actually present non-current assets and liabilities ahead of the current ones. But then again, in the Philippines, we present the current ahead of the non-current. So also to emphasize that these are the minimum. So in other words, these are just the items that are treated here as an example or as examples of items that we can see on the balance sheet or statement of financial position again, but this is not like the exclusive or exhaustive list. So this is not to be treated as a complete list. As said, minimum, so meaning common items that we can see. Or these items, we can then say should be seen because these are items mentioned in IAS 1. However, provided if applicable on the situation. Because for example, for letter F, biological assets, so these are the living plants and animals with certain exceptions that we will know of in other accounting subjects. So we cannot present this one just because it is said in the minimum line item, even if we don't have biological assets. So that's why I said we can expect to see these items as a minimum, but only the applicable ones. Then another one will be, this one will be on the liabilities. So K and L and M, actually, as well as N, could be for normally current liabilities, except for M. M could also be non-current. So of course, if it goes beyond the 12 months or normal operating cycle, whichever is longer, then that's going to be non-current. Deferred tax liabilities and assets should always be non-current, as also in accordance to PAS or IAS 12, income taxes. Then P under PFRS 5, so this would be current items, so assets there on the previous group. So we have letter J, well, the liabilities on the disposal group. So there are certain non-current assets which are now classified as held for sale. So by then, the non-current classification prior will make it current in the current times under PFRS 5. And Q and R will be on the equity. So liabilities and equity continuation. Now, order or format, as said, there is no prescription as to the order or format. Next, financial statement is the statement of profit or loss and other comprehensive income. So what I've mentioned, the statement of profit or loss is actually the same as income statement that we have known of. And then there is an addition of the other OCI items or other comprehensive income items. Formerly, in the previous versions, like just income statement, no OCI items. Actually, these OCI items are coming from the statement of changes in equity. And under statement of changes in equity, there's a section there for other comprehensive income, formerly known as reserves, in which there they are the cumulative versions or balances. So combinations of all the gains and losses under years. But then for the current amount or version, that's what we can see on OCI. So just for the period ended. And then if we take it as a whole, so combination, we call this a statement of comprehensive income composed of profit or loss and other comprehensive income. So profit or loss plus other comprehensive income equals total comprehensive income. So we can present this as one or two statements. So this is also an option. It's not a requirement to present it as one item. But if it is two statements, so the first statement would be showing the profit or loss or income statement version, and the second will be carrying forward the profit or loss balance, and the continuation will be the OCI to make the total comprehensive income. Next, for extraordinary items, so there is no more extraordinary in PAS 1. Prior to this, like probably on the US GAAP, so there is a provision about extraordinary items, most especially like losses coming from fortuitous events, or those items or those losses or loss items stemming or coming from fortuitous events or acts of God or situations beyond the control of human beings like earthquake, volcanic eruption, flood, typhoon, etc. So these situations would result to losses, especially for the assets. However, before it was actually allowed to present them as extraordinary, probably because they do not happen like most of the time. So they just happen on certain occasions or situations. However, if we are going to analyze and think it nowadays, it seems that they are common things happening. So that's why no more extraordinary items. So all items are treated as ordinary items and can form part of the statement of comprehensive income, profit or loss section, or other comprehensive income section, or in the notes. Then other comprehensive income for the period, these are the common ones which you will meet in the future time. So it is not necessarily though that we will have to dissect this one by one, but then just like a short overview or one sentence description for letter A, changes in revaluation surplus. If for property, plant, and equipment, if we are using like the revaluation model that we use, the fair value. The fair value is the value in the market. So if we use that, we have to adjust or continue the revaluation so that the value of the PPE item, property, plant, and equipment like building would be, or the land would be equivalent to what is in the market or are in the market. So that's why we have to incorporate also that. Then letter B is for the unrealized gains and losses on investments in fair value, also security. So financial assets at fair value through other comprehensive income. Okay, so anyway, financial instruments, that's one item that we will tackle in the future. Letter C is for the employment benefits, especially the post-employment in terms of the remeasurement of the asset. We also have to include that. Then if we, for example, translate the financial statements of a foreign operation, let's say Jollibee Foods Corporation has a lot of branches worldwide, and then these financial statements could be presented on the currencies there. So if we prepare the consolidated, the total financial statements of Jollibee Foods Corporation as a whole, so there is a need to translate those financial statements to be equal to the Philippine currency. So in that case, there could be gains and losses that would arise out of the translation. So that's also OCI item. And E, if we are going to protect ourselves with fluctuations of cash flows of our assets and liabilities, could be inflows and outflows. So the effective portion will have to be part of OCI. So again, we don't have to memorize these 5 here yet, but at least we can familiarize like these items as of this point in time. Then OCI may be presented either net of tax or gross of tax. However, because profit is or loss is already net of the tax effect, so that's why OCI will have to be merged or added to the items here net of tax. Okay, next is reclassification adjustment. So for reclassification adjustments, these are amounts reclassified to profit or loss in the current period, which are coming from the OCI. So reclassification adjustments could also be called as recycling adjustments. So far, out of the 5 items here that we have mentioned, so only the 3 items, the second item under C, debt instrument that is allowed for reclassification, translation differences, and the effective portion of cash flow hedges. So those are the 3 items allowed that we transfer items from OCI to profit or loss if ever these items have been realized through sale. Then total comprehensive income. Total comprehensive income is again the component of profit or loss and other comprehensive income. So those 5 items mentioned under OCI. Profit or loss is simply the difference between income or revenues and expenses. Okay, so to continue, the expenses can be presented into 2 ways for a while. Okay, so the next is this one, nature of expense and function of expense. So for the nature of expense, basically we call this a natural presentation wherein all items of expenses that are grouped together based on the nature, like depreciation expenses, like all about the salaries, rent, so they are to be presented there, not necessarily by function or not classified into functions. And then that's by nature. We call that the natural presentation. But if functional or function of expense, we now group them into 4 functions. So selling and selling expenses rather for the items involving the cost or expenses related to sales. Then I was about to say administrative, so that's also another one, administrative expenses, also known as general administrative expenses. So these items are actually expenses related to the general administration of the business. So selling could be the salaries of the agents, the depreciation of the vehicles that are used for selling or distribution. That's why distribution costs, another term for selling expenses. Then commissions to the agents and their salaries. So those things related to sales. Whereas for general administration could be the salary of the accountant, the, let's say, staff salaries, depreciation of those offices used in the general administration, not the selling, because all depreciation and expenses related to selling will be charged to selling expenses if based on function. Another one will be the finance costs related to interests and the bank service charges. So all transactions related to borrowing of money and all other expenses not classified under selling, administrative, and finance will be under other expenses. Example of that will be losses coming or the casualty losses coming from the fortuitous events or acts of God, like typhoons, volcanic eruptions, and etc. If we classify by function, there is a need to disclose in the notes for the additional information as to what composes those 4 functional ways or means of presenting expenses. So they have to be disclosed in the notes of financial statements. Then dividends also will have to be disclosed, and then they have to be declared by the entity. So they are already ready for the distribution to the shareholders or investors of the corporations. These are dividends. So normally financial accounting is geared for the corporations since we mentioned here about shares. to be disclosed either in the notes, if, for example, this has to do with a liability that is not yet to be distributed, or statement of changes in equity. So, well, you will know later on in corporation accounting that dividends declared will have impact on the equity because it will be treated as a deduction to the accumulated profits and losses, also known as retained earnings. Well, in the notes would be the details like how much per share and other details like when will that be given and so on. And finally, this is the last part. This would be the order of presentation of disclosures in the notes. So we begin with statement of compliance with PFRS or SS. As said, to be compliant, we should be following the standards that are applicable to certain entity. So all applicable accounting standards. Then after that is out of the standards. Remember, we develop accounting policies for the company. So the framework, rules, conventions, that we use in our accounting processes based on the standards, the summary of them will have to be disclosed. Then number three, supporting information for items presented in the other financial statements and the other disclosures then. All right. So this is the end of the presentation of the part two of PAS1, presentation of financial statements. So see you next time, and hopefully you've learned something in this session. Then thank you and God bless.